So oh, oh,
Test, test, test.
so I think since so she's so you know so and I set nice I put
Okay, Andrew, hang on one second. Let me make sure I got the speakers on here.
Hi, can you hear me?
Yeah, I got you. Give me just a second, Andrew, and I'll introduce you.
Testing, testing. Hello?
We got you. Hang on.
Oh, good. I got you.
Hey, Andrew, give me a second. I'll introduce you, and then I'll turn my computer around so you can see the crowd.
Sure. Sorry about the delay. I just realized I had to install Google Chrome. Like Firefox isn't supported anymore.
At the last minute, just like me. Always trying to get everything put together.
Yeah.
So guys, this is a very special guest tonight. He is the lead developer of Bitcoin Unlimited, and he's probably, I'd say, close to 100% of the reason that you can do Bitcoin Cash and bigger blocks. Andrew, if you'd like, feel free to reintroduce yourself, give us a little background, and then you've got the floor for 10, 15 minutes, and then we'll have a couple questions for you. Take it away.
Great. Yeah, so my name is Andrew Stone. I'm the developer of Bitcoin Unlimited. I kind of founded the Bitcoin Unlimited team. And for those of you who know something about the history of Bitcoin in the last year, we were attempting to increase the block size for the last year. And at one point we had about 45% of the hash power voting for a block size increase. And then subsequent to that, we kind of stalled out at 45% due to certain Chinese miners, and the SegWit 2x compromise sort of came out of this this stall, and so then Bitcoin Unlimited has moved on to working on Bitcoin Cash mostly, although we do have a Bitcoin client. And the reason why we didn't support SegWit 2x so much is because the activation time wasn't the exact same. The large blocks in the SegWit weren't activated at the same time, so we didn't trust it. And I guess our lack of trust was not incorrect in that regard. So I guess without any more introduction, I think I'll hop into what I had planned. Let me see if I can share my screen. You guys are you guys seeing me?
Yeah, we've got you good. We've got the sound good. Everything's perfect. You won't see me. I'm kind of off screen, but yeah, let's go. We're ready.
So that helped. So let's see if I can. Yeah, so I can just. Okay, so you should see some slides.
We've got it. Yeah, looks good.
Okay. So I don't actually know the sophistication level of you guys. So I kind of geared this talk just today. I kind of put it together to people who maybe are interested in Bitcoin, but aren't, and maybe are investors, but they're not perhaps, super techie developers. But if you are, then I'm, happy to, after the talk, discuss any questions you might have about anything really. So let me just hop in. I'd like to talk about the scaling debate and why, even though it's kind of over, you should still care about it. So a lot of times when Bitcoin was young, we'd get this question: why is Bitcoin not a Ponzi scheme? It's just a Ponzi scheme. And I would always reply that it's useful because it's useful, and it's useful for moving money from point A to point B. And it actually was both cheaper to do that, and also it took a lot less time, which I think is an issue that people didn't consider. But especially moving money internationally, it would take hours to fill out all the forms, and deal with all the crap. And time is money, right? So every time that happened, it was one more user who said, oh, I should just hang on to some Bitcoin for the next time. And that created value. And obviously, it's also useful as a store of value, but that's a little bit dangerous because it's only a store of value in a secondary sense, because it's first of all, useful. And then even though the store of value function, especially now, might be the majority of its value, it does need to be based on some fundamental useful property. So the question, of course, then would be, well, what's the most useful crypto? And the answer today, I guess, is Ethereum, which, by the way, I grabbed like a lot of these slides and quotes from stuff that's been going on in the last week. So I'm not personally attesting to the accuracy of, like this graph, because I always put down at the bottom where I got it from. But at the same time, it's sort of agreeing with my intuition of what's been going on in the space. So I think it's useful to have it. Are you guys seeing like the whole slide, or are you seeing portions of it?
We've got it on a projector screen, so it's huge. We're doing good over here.
All right. Let me try. Okay. I'll leave it as it is then. Okay. So Ethereum is now has the most transactions of all of the cryptocurrencies combined. It has more than all the others combined. This is like, basically from an old-time Bitcoiner like me, I've been investing since 2012. This is like shocking and scary. Because as I was saying, the answer I always gave about the Ponzi question was fundamentally it's useful for transactions. So how in the world can Ethereum do all of these transactions if it's not possible to create more than 1 megabyte blocks? Well, the short answer is it is possible to create greater than 1 megabyte blocks. And here's a little graph that was zooming around Reddit just today or yesterday. Basically, this put it all really nicely. Hard disk capacity has increased dramatically. Internet speeds increased dramatically. Processor speeds increased dramatically. The block size has stayed the same. And one thing that they don't mention here, too, that's really important is the transition from spinning platter hard drives to reasonably affordable flash drives, because flash drives are orders of magnitude faster than hard drives. So basically, the capacity placed on Bitcoin is completely artificial, designed to restrict its growth. Why that might be, I'm not going to make guesses because it's not my choice. And in fact, about 3 weeks ago, I went and presented at the Scaling Bitcoin conference in Stanford, and because we are working in Bitcoin Unlimited on a project to sort of investigate the limits of scaling using current hardware and worldwide. In the worldwide network, we buy time on machines all over the world, and we reported these results. So there's a full presentation with all kinds of details. I'm just going to skip, of course, to the good part here. So this is a test across like an 18 node network. And what we basically do is we ramp the transactions per second up, and we watch to see whether the network retains basically coherency, right? Whether your transactions propagate all throughout the network. And basically what happens here is we get up to about 1,000 transactions per second, and things start to break down a little bit. It still kind of works, but some transactions don't end up propagating because nodes are busy dealing with other stuff and so forth. So that's 1,000 transactions per second. The maximum that Bitcoin could do, like does today, is 3 transactions per second. So you can barely even see that on this graph. So there are the limits to Bitcoin scaling are completely artificial, unless you do want to force individuals to allow, I should say, individuals to run Bitcoin on toy machines like Raspberry Pis and other simple, $30 devices. Now, I love the idea of running Bitcoin on a $30 device, but I would not want to deny Bitcoin to users all over the world for the sake of running on cheap hardware. All right. So now I want to go and talk a little bit about the price and the effect that this situation is having on the price. So here I have a graph of, I need to make this a little smaller so that we can see both graphs at the same time. Okay, so I have a graph of the amount of transactions in the memory pool and the price. Now, what's interesting is, as you might imagine, as Bitcoin, and this is about over the last year. So in prior years too, the same it was true as you'll see in this graph. Basically, if you see this little bump in the price here, it kind of corresponds to additional transactions on the Bitcoin network. And then the price goes down and there are fewer transactions. And then, oh, we have a nice run up here. And look at all these transactions, right? So basically, there is a strong correlation between the use of the network and the price rising. Now, this makes perfect sense, right? Perfect sense. Because obviously, people get excited about Bitcoin. They buy Bitcoins and they use Bitcoin, right? Okay. So now let's fast forward to what happened a couple of weeks ago. Oh, and here's another example. So, I mean, the trend is it's just up until a couple of weeks ago, you could mark time on this. It was just, you only had to have one graph. But here we have this really strange effect. And notice that the memory pool was unbelievably congested, the second highest it's ever been. And by the way, this is, if you see this huge orange section here, there's a strong argument that that was someone cheating. Those were people, that was someone spamming the network for some reason, probably just to prove a point, okay? But even if you remove this whole orange, this is a lot of transactions on the network. But this has no wide band of, so the reason why we think this is spam is because the orange basically means that all the transactions are the same fee. And if you really wanted, your transaction to complete, you wouldn't just send it with the same fee as all the others, right? You'd send it with a little bit more. So here, there are no wide bands because everyone is trying to outbid everyone else to get their transactions committed in Bitcoin. And the funny thing is we see something happening for the first time ever in the price, which is that the price is just crashing, right? Now, this is over the massive run up that we've had, this is a relatively small movement, but it's actually the largest kind of tight, like this movement down here is a little bit larger, but it also took a longer time. So this is the fastest descent ever, basically. I mean, that has happened in the last year, the fastest descent of this bull market. So let me zoom in on that, just to make it absolutely clear that there is a correlation. So I didn't quite align the dates quite exactly. So this is November 13th here. November 13th hits here. So the peak here is just before the 13th. Same is true here. That's just a little zoom in graph. Okay. So basically, what happened on that date is SegWit 2x it was canceled. And so all the people who had been holding out for the last idea of scaling on chain basically decided to diversify, right? So this is the people diversifying. Now, who are these people who used to believe in Bitcoin and don't anymore? Well, unfortunately, you know, these are people who several years ago were the you know, the industry leaders, right? These are Roger Ver, who has you know, huge numbers of bitcoins. These are Bitcoin companies like Coinbase, which I guess now holds more Ethereum. These are you know, people like me who are longtime Bitcoin supporters, some developers who were there in the beginning. So I don't know where you fall in this debate, and I'm not asking you, I'm not trying to convince you that scaling is better on chain. What I'm trying to convince you of now is that a significant portion of the community is essentially disenfranchised. Now, I see this as essentially a warning shot. Why? Because everyone, while people may be disenfranchised, we know very well that Bitcoin is very popular in the media and so forth. And so you would be a fool if you would sell all of your Bitcoin, right? But it was for people who, a lot of people, including myself, who believed in Bitcoin, thought that, you know, there was going to be one currency, right? Because anything any other currency can do, Bitcoin can do better, and it has the advantage of wide adoption, right? Well, that's not true if you artificially limit, you know, the technology. Okay. So what was happening also during this time? Well, Bitcoin Cash, which is a fork of Bitcoin that was created in August to allow large blocks. So by the way, if you you probably know this if you follow the Bitcoin news, but if you don't, I'll just mention it. So the fork happened in August, and what a fork of Bitcoin means is that if you had coins, if you had Bitcoin coins before the fork, you now have those same coins on both the Bitcoin Cash network and the Bitcoin network. But if you you know, obviously bought your coins after the fork, then you don't. Okay, so really, like the value of the holders is preserved. And if you so this is one of actually the amazing properties of a blockchain, which is that if you disagree, you can split or fork the blockchain, and people who can't make up their mind or don't want to make up their mind, they don't see losses, right? You're not forced to choose. You can just continue to hold your coins. But anyway, so Bitcoin Cash, you know, was put on the map. And so why is this graph so low here? The reason why is because right on the 13th here, by the way, this number is about $1,300. So this is not chicken feed. The price spiked all the way up to, I don't know, $2,000, $3,000. And then it obviously it crashed back down because, I mean, this is just whatever. This is just people, you know, being a little silly. However, as you can see, it's stabilized. It's kind of stabilized out at around 1,300, starting to continue its, you know, more natural climb. So this is indicating people who are leaving Bitcoin because there's a corresponding price decrease, and you can see that also in the market cap of Bitcoin relative to other cryptocurrencies. You know, in the beginning of the year, it was like 85, and then it dropped all the way down to less than 50%. And now it's slowly climbed a little bit, but this is the big fall due to Bitcoin Cash. Now, what's happening here is, you know, the long-term holders are leaving, but of course there's tons of new money coming into Bitcoin. People are investing in cryptocurrencies. So, you know, I think it's silly to imagine, at least at this point, that Bitcoin would fall, right? Because for every dollar leaving, there's probably $2 or $3 of people wanting to come in. Okay, so this is the effect of the great scaling debate. It's fractured the community. Significant portion of people have left. And I think it's important for potential investors to understand this, right? And that Bitcoin, in the view of a significant minority or even possibly majority of individuals, is not meeting the goals and the potential that it was set for it back in 2012. So if you watch, old speeches where people say Bitcoin can do this and that and the other thing, those speeches may no longer really apply. So I want to leave. This is my last slide. I'll open it for questions. I want to leave with some final thoughts, which is that Bitcoin has massive mindshare network effect. Right now, we can't ignore that, because I mean, it's like the entry into the crypto market. And as I was saying, no matter what happens with people leaving, there might be more people wanting to come in. And that Lightning might work. And also it might turn Bitcoin into basically a centralized settlement network with user access via credit card-like scheme. This is where you open your Lightning channels, right? And even if that's the case, the old Bitcoiners like me, we may not like that. We didn't want to produce another credit card scheme. But ultimately, does the consumer care? Maybe the consumer does not. So these are the advantages. This is what Bitcoin has going for it. Now, in terms of Bitcoin Cash and other cryptocurrencies, here are some thoughts I want to leave you with. First of all, what happens to Bitcoin after the pop if the true believers has already left? So, I've invested through 3 crashes in the Bitcoin market. And the thing that stopped Bitcoin from failing was that people believed in the currency as a, efficient means of transfer and a storage of value. So if the people who leave are those people, and the people who stay are the new people coming in, who are, hedge funds and mutual funds, they don't care, right? They are going to get out in the first sign of panic. Now, I don't know actually who's coming in and who's going out. This is all just supposition. But from a business perspective, Bitcoin Cash can deliver scalability via on-chain, Lightning, and future technologies. We, in terms of, the great scaling debate, we'll do Lightning. We don't care. We just want these technologies to compete against each other in the market so that the best technology for a particular application can win. And finally, with Bitcoin Cash, we can deliver better features faster, because we can do a protocol upgrade or a hard fork. Basically, we're just changing the protocol and telling everyone to upgrade their software, which is a lot easier to do, just from an engineering perspective, than to endlessly support the old and obsolete behavior. Basically, that takes a tremendous amount of time, and there's a lot of complexity. Complexity theory states that you're more likely to have failures. You have complex interacting parts that you haven't really considered the ramifications of. So the more old parts you have that you don't really use is one more part that can cause something to go wrong. So in terms of, perhaps you're thinking about going into Bitcoin, doing some investment, I just thought I would share kind of the state of Bitcoin. So any questions?
Okay, yeah, so I'm going to have a couple questions from both the audience, but what do you think? Will we see Bitcoin Cash in Coinbase or Gemini or Kraken? It's already there. What do you think with Coinbase and Gemini?
I think that these two companies move slowly because they have regulatory issues and so forth. However, for example, Coinbase has always supported larger blocks, and they actually were one of the first companies to come out and support larger blocks, and they got smeared in the small block media for that. So I think that Coinbase is will end up supporting it, and the same with Gemini.
Okay, couple audience questions. Here's the first one.
Hi, Andrew. Your
Hi.
opinion regarding Overstock.com's technical capabilities related to their T0 blockchain launch next month?
I'm sorry, I haven't looked at the technical details of their blockchain, so I can't really comment.
And here's another one.
Yeah. So Andrew, as I understand it, to have a hard fork, that means that less than a majority of the people agreed with the change that Bitcash wanted, or Bitcoin Cash wanted to make. So, am I understanding that right? That the majority of the decision makers with Bitcoin disagree with you?
Yeah, yeah. So that's an interesting question, and so basically, in the original Bitcoin Cash hard fork, we forked with the minority of the hash power. So on the surface, that is correct. Now, Bitcoin Unlimited's adoption was ultimately hampered by F2 Pool, and I even went to China to talk with them. So F2 Pool has massive GPU mining capacity, even more than Bitcoin, although they had like 10-15% of the Bitcoin network, but at one point they were a majority miner of Litecoin and Ethereum. So I think that you can understand why F2 Pool would want to hamper Bitcoin's adoption, to push people into other cryptocurrencies, the ones that they're mining. So there's an example of, so when you think of an example of how certain individuals might have conflicting interests in the space.
Okay, Andrew, that we're actually past time. I want to say thank you very much for everything you do in the space. Again, I appreciate you coming on board. We hope to see you up here one day. We're going to have a crypto event in March, spring of 2018. We'd love to get you up here. If
Cool.
you get a chance, tell Roger we'd love to have him come talk as well, and let us know what we can do to help you out. And I love what you're doing. I appreciate everything. And guys, big round of applause for Andrew Stone.
All right, thank you. Good luck, guys.
Hey, thank you very much, my brother. We'll talk to you a little bit.
All right, bye.